In the topic of digital finance now, we're going to hear from Bryan Zhang, a leading voice in digital finance research. And he's going to walk us through how global innovation is accelerating beyond policy frameworks and what this means for capital deployment. So please welcome Bryan to the stage.
Thank you very much. Good morning, everyone. There's a lot of been talk about the mega trends, right? In terms of AI, tokenization, stablecoin, quantum. We heard a lot about those this morning. So I can share with you some data, share with you some mega trends. But I think more importantly, for your time in the next 10 minutes, 15 minutes, is to share with you a thinking framework. The framework will help you to bring all those concepts together, to cut through the noise and to discern signal. But also not only to talk about the market side, but I'll talk about policy, regulation, supervision, because those two are linked together as our last panel was pointing to. So, a little bit of information about myself and my center. So we established the Cambridge Center for Alternative Finance, or the CCF, 10 years ago. So we work very particularly, because we work with, on the market side, 5,000 fintechs in 195 countries. But we also collaborate very closely with about 350 central banks, securities regulators, capital markets authorities, and Ministry of Finance. We're very proud to be the probably only research center in the world in the same month will be serving Bitcoin miners and central bankers. Because I think that trust, the perspective from both the market side and the regulatory side is really, really important as we move forward. I also sit on the board of FCA, advisor to other institutions, but of course today I'm speaking in my personal capacity. So what really is happening, as capsulated by the conversation this morning, is we're undergoing a great financial transformation. This is propelled, underpinned, driven by the confluence of technological drivers, right? The ABCD, right? So the AI, the big tech, cloud, DLT, but also coupled with social, economic conditions and the geopolitical factors. And together, they are shaping the financial services as we speak. In the framework, I like to call 3 A's: actors, activities, assets, and architecture. What do I mean by that? Now, 30, 40 years ago, the stage of financial services was crowded but simple, right? We have banks, asset managers, insurance companies, so on and so forth. Today, that stage is very crowded. If you look at the actors, of course, we have banks, but now more and more we have fintechs, we have big techs, we have non-financial institutions, we have telecommunication companies, and we have AI agents. Because when AI agents has agency, we'll classify them as financial actors. Then over the last 10 years, we have witnessed the rise of a wide array of new activities, right? From crowdfunding, peer-to-peer lending 10 years ago, to buy now, pay later, tokenization, open banking, open finance, open data, embedded finance, cross-border payments. And they're now leveraging those activities, a wide array of assets. No longer just fiat, as the last panel has said. We now have private issued stablecoins, tokenized bank deposit, tokenized financial and real-world assets, but also wholesale CBDCs, retail CBDCs. We have crypto. All that is conducting both in traditional financial architecture, but also in new financial architecture. We talk about data sharing through APIs, cloud computing, quantum, but also digital public infrastructure. So that is the framework I hope will be a little bit useful for us to think about those mega trends. But what's happening, but what's to come. So let's use this framework, shall we, to talk about digital assets. So our working thesis after research in this space for the last 7 years is all assets will be digital in 5, 10, 20 years' time. Either natively digital or become tokenized form. So that's our thesis. If you look at actors, we have new actors. Some activities are definitely new. Bitcoin mining is new. Digital asset custodian is new. Of course, new asset classes and new infrastructure. right? Both traditional but also decentralized financial services. So we talk about tokenization and its potential. This is from Citi, right? If we talk about potential for tokenizing sovereign debt, real estate funds, private equities, and we talk about trillion dollar market, right? But we can analyze what's happening in digital assets using this framework. Always think about who are the actors, what activity do they undertake, what assets they leveraging, and within what kind of infrastructure. Stablecoins. Let's use that as a test case about this framework, right? So we have a wide range of actors. There's a battle for the control and authority in terms of money, right? Who can issue money? And there's a question about singleness of money. Because 30, 40 years ago, it's just central bank money. Direct liability with central bank, right? Now we have, of course, decentralized networks, non-bank companies, big tech, commercial banks issuing the different forms of money. If you look at stablecoin, they are conducting new activities, such as the company Circle, which went IPO at the New York Stock Exchange just 2 weeks ago, right, at about 7 billion valuation. So they're doing stablecoin issuance, redemption, exchange, custody services, all new activities, and leveraging different kind of infrastructure. And they are quite systemic in a way, because if you look at the chart at down at the bottom to your right, Tether, which was mentioned on the panel, was the 7th largest purchaser of US Treasuries in 2024, more than Mexico, Germany, and Canada combined. And collectively, today's stablecoin issuers are the 10th largest US Treasury bills in the history. Now, here are some data from our Cambridge Digital Money Dashboard. It's a free resource for you and your colleague to use, right? Because we're not commercial. So this is using secondary data, but also Chainalysis data to give you a proxy analysis of the geographical distribution of stablecoin inflows and outflows. You can see all over the place, of course, North America still dominates, but in emerging markets, in Africa, in Latin America, in the Middle East, in Asia, that's where the activities and momentums are coming, right? And a lot of central banks and regulators I talk with, they're worried because it's dollarization through the back door. And they're worried about losing sovereignty control of the transmission of the monetary policy. Because when I was in DC just last week to attend the joint World Bank IMF meeting, US, I think Commerce Secretary testified in the Congress. There was a question to say, look, how big do you think what's the appropriate size of a stablecoin, right? And he said 2 trillion, right? So this will continue to gather pace. So we really need to think about opportunities, of course, financial inclusion, but also think about systemic risks. That's really important. Another mega trend is what I describe as the continuum of open banking, open finance to open data. And globally, we're seeing nearly 100 jurisdictions opened up the banks, either by market competition or by regulatory remedy to force the bank opened up their data and allow consumers to exchange data with the consent, right, for better services and products, cheaper access. So our data showing just in the last couple of years, from 2018 and to 2022, there's 95 jurisdictions have embarked on that journey of open banking, open finance, and open data. And that will change different business models. That will put spotlight on data exchange, data sharing, but also data privacy and data protection. Third trend I want to talk about is the permeation and proliferation of non-bank financial institutions. So you may never heard of the name M-Pesa, but in emerging markets, that's a big successful story based in Kenya. And that's basically a subsidiary of Safaricom, which is a part of Vodafone, right? They started operation in Kenya 10 years ago for e-money, digital wallet services. And today, it's one platform, one fintech, is channeling 75% Kenyan GDP. 75% of Kenyan GDP. This is almost getting into the category of a too big to fail. Right? And other actors are also very interesting. Starbucks, by strict definition, given its hold what they call deferred revenue, it's a bank. And it's bigger than many, many of the US state and regional banks, right? So make no mistake, Starbucks is in financial services. So are the big techs. So Google, Apple, Samsung, Amazon. They are already getting, e-money license, payment license, banking license in 150 different jurisdictions. So that's changing things because that new actor enter in financial services. So AI, we talk about AI a lot, but where are we? I really like this picture, which is from Jason Huang's keynote in this year's CES, right? So it's all started with the neural network model, right, back in 2012 with AxonNet. And then you start going upstream to perception AI, Gen AI. I would argue we're right now at the very beginning of agent AI. And the last stop will be physical AI, basically a combination of AI in software and robotics, right? So robots. So that's where we are. Now, if we use the same framework to do some analysis, right, to make sense of this growing industry that is intersection between AI and financial services, and you see the confluence of technological drivers, right, with the introduction of the transformer architecture back in 2017, underpinned that by that paper, attention is all you need. And then we have a new actors. We have now autonomous financial agents being deployed, right, by big tech, by small tech. We have AI-first fintech, tiny team fintech, but also regtech, subtech companies. And that gave a rise for a new raft of new activities that based on either Gen AI or agentic AI, and leveraging different forms of assets and within different kind of architecture. And that's the significance because no innovation happen in isolation, right? They're all happening in the sort of confluence in the system. So we wrote a paper with the World Economic Forum back in December last year to talk about what this means in financial services. And I would argue besides more automation, more efficiency, more effectiveness, is the promise of agentic AI plus model. So we talk about open finance, we talk about tokenization. When you deploy live agents, right, and make that to integrate with the current open banking, open finance systems, you get something like personal shoppers, right, for consumers, or self-driving treasuries for SMEs. That means the agents that you deploy will automatically, using your consent through API, to shop for you the best insurance deal, right, the best mortgage deal outside of your bank. And in terms of agentic AI and tokenization, right, we already see examples in terms of Coinbase, right? They're already doing on-chain liquidity management. And the combination of agentic AI and embedded finance, especially buy now, pay later, would be enormous opportunity. And just 3 weeks ago, both Visa and MasterCard, in the space of 24 hours, launched, they are offering live agentic AI payments as a services for their merchants globally. Right, so the race for agentic AI is already underway. So from a regulatory perspective, I like what the last panel said. We should not rush into this because there are a lot of risks. We are familiar with a deep fake. We are familiar with the undermining of our trust in financial services and amplification of biases and discrimination. What I'm particularly worried about is this disconnection between the upstream and downstream. What do I mean? A lot of providers or vendors of AI services, they sell applications, sell AI agents, sell automation services, but they're more or less based on the large language model developed by the Big Four. Okay? Now, if something goes wrong, let's say AI agent goes wrong, AI agents become to discrimination against women, against people who live in particular, postcode, who will be responsible? Will be the agent itself, now it has agency? Will be the company who use those models? Would it be the third-party vendors? Or the big techs? Right, there's a huge issue about accountability, governance, and how can we manage and mitigate risks. So we really need to think about from a regulatory policy aspects as well as the market opportunity side. Okay. Now, so I talk about there's a great financial transformation underpinned by a new set of actors, activities, architecture, and assets. I have to talk about regulation. Because coupled with policy inertia, regulatory latency, supervisory deficiency, what you have is a widening and widening innovation delta between the pace and scale of innovation in the marketplace and the regulator's capacity to regulate, supervise effectively. Because financial innovation happens in exponential times, right? They grow by exponential numbers. But of course, legislative process can be in glacial times. So what we have is this innovation delta manifested by temporal mismatch, structural fragmentation, and huge divide, both in terms of knowledge, but also in terms of technology between the innovators and regulators. And leave this innovation delta to grow and widen, we are jeopardizing the potential for furthering policy and regulatory objectives in terms of financial stability, consumer protection, competition, and growth, especially in the period of a permanent crisis and predictable volatility. So what do we need to do is to think about how can we cultivate, accelerate the pace of a policy innovation, regulatory innovation, supervisory innovation, and infrastructure innovation in the public sector. I'm talking about security regulators, central banks, Ministry of Finance. How can they be innovative themselves by learning, by big capacity building, and by digitizing? I put forward this thesis called, we need to build a more innovative regulatory system by having more modular, adaptive, and regulatory policy and regulatory frameworks. Think about, we need a regulatory Legos, right, to supervise financial Legos. We need a machine-readable and machine-accessible regulation to digitize your rule books, right? So can we do embedded supervision? We need a lot more training. We not just need lawyers or economists in the regulatory agency. We also need the coders. We also need a behavioral scientist, right, to really have that interdisciplinary approach. And the last thing I want to say is we need a more collaboration within the agency, across agency, and especially some cross-regulatory cutting areas such as data protection, competition. We need to do more collaboration cross-border as well. And so where does this lead us? So the final state I hope this will lead us to is one day, 5, 10, 20 years, 30 years time, the regulatory side will achieve a state of a regulatory singularity. Right? That's an aspirational state in which regulatory systems are continuously adaptive and capable of co-evolving with the financial innovation in near real time. So the innovation delta no longer exists. That means a regulator, from the time it detects a risk to enforceable action, that interval, that gap, will become closer and closer to zero. I will leave that to you, and hopefully you found that useful. Thank you very much.